What's going on, everybody? Welcome to a capital hungry live market analysis and breakdown on both fundamental and technical perspective of the trading pair EURUSD. Now, there's some issues going on with YouTube streaming service where for some reason the chat is disabled today. You guys know I usually love to have the chat open, answer people's questions, banter, see what everybody's talking about, and have some fun. But it looks like YouTube's having some issues today. For some reason, the chat is disabled for this live stream, and I can't turn it back on. I don't know how to turn it back on. It's not giving me the option anywhere here on the screen. So it is what it is. It's all good. We're just going to stick to the value, the main meat and potatoes of the dish being served this evening, which is the analysis and trade ideas, right? Now, as this is a rare webinar, I just want to go through the higher time frame, breaking down some of the key events that brought us to where we are today, and then using that information alongside some of the events we have in focus to give some forecasting of price and potential trade ideas more on an intraday and swing perspective. But obviously with some of these key price points we will highlight, you can obviously use them for scalping ideas as well. Just adapt accordingly. So right here you can see on your screen is EURUSD and the daily chart. We're just going to be breaking down some of the key movement and events over the last couple of years. For those of you who are unaware, the reason why EURUSD was so bearish through the primary period of 2021 as well as the majority of 2022 was for two main fundamental macro reasons. First was Russia invading Ukraine, which shifted market risk flows, bringing more demand in your safe haven asset classes and safe haven currencies such as the US dollar, and less demand in your basket of risk assets and risk currencies such as the euro dollar. Also, later into 2021, going into 2022, the Fed started giving signals and actually taking action towards the most aggressive rate hike cycle we've seen in history, completely shifting their monetary policy mandate to again to stop from sorry, I thought my screen was frozen. Anyways, completely shifting their monetary policy mandate from supporting the economies to combating inflation, bringing increased demand in the US dollar. And because the US dollar is your global business currency and world reserve currency, this obviously takes control in the pair EURUSD or any pair that dollar was in. GBPUSD, AUDUSD, NZDUSD all had very similar macro movement. Now this led to a monstrous bearish run all the way to 0.96 as EURUSD went to the parity point with the dollar being 1-to-1, a very key historical event that took place. But as we were approaching the end of the fiscal year of 2022 and setting up 2023, a lot of the events regarding Russia and Ukraine were of course priced in, and then majority of the Fed signals towards rate hikes were also well priced in at that time. So we started to see a large correction of this bearish downside move, which we've seen now extend to a very key price point around 1.1. Now, what's important here is you can see on the higher time frames, such as the weekly, we're still respecting this sequence of events where we cannot expect full upside on EURUSD just yet, as overall EURUSD is very bearish on a macro perspective. This is still a pullback coming from significant higher time frame lower lows, and you can see it's very common for EURUSD on a macro perspective to retest previous historical low price points multiple times, and if you still fail to break, can easily get some reversal signs of EURUSD digging back lower to go to the parity point or at least to 1.05. Now, when we're looking and backtesting some of this price movement, from a fundamental perspective, we don't have confirmations for dollar strength back into the table just yet, right? We do not have those confirmations. Right now, over the course of the last weeks and months, we've actually had economic data feeding into a weaker dollar sentiment. US recessionary scare data, and of course, inflation figures declining, which is having the markets price in a future lower interest rate environment, and then of course leading to some dollar weakness. Okay, so right now, even though we're coming to retest this key price point, we can't jump ahead of the curve and start to get too hasty just expecting reversals, because when we're looking at our correlation confirms here, we're at a very key price point of interest on the dollar as well. Dollar will need to bounce and have fundamental catalysts to support buyers pooling in liquidity from this very key zone around 101.5 to 102. We're going to need optimistic US data, increasing inflation, or further hawkish pressure from the Feds, or new geopolitical tensions of fear, uncertainty, and doubt for dollar to respect this area and buyers to come back into the scene. Understanding US dollar is your world reserve currency and global business currency, this will obviously correlate directly to your dollar pairs, and if we have dollar hold this area with fundamental catalysts to support that upside, that will lead to a reversal of EURUSD from this key higher time frame sell side liquidity zone and bears coming into play. But right now, we're just getting potential reactions at these areas, just getting fundamental catalysts coming into play that have brought us to these areas. We have not respected these areas just yet. What I mean by that is, when we're looking at this key price point of interest from a historical and fundamental perspective here, on dollar, this is the first key higher time frame demand zone of interest, where during the dollar domination phase, we accumulated buy-side liquidity with buyers pulling back to this area, collecting more buyer volume, and of course extending higher. We broke above these historical high price points here from the 2015 all the way to the 2020 period. We had this initial bounce here with optimistic US data, faded it out as we've had data reports bringing us back down to this area. The reason why we've come bearish back down to 101.5 This is the main reason. Over the last couple of weeks, we've had declining US economic data feeding into a recession scare narrative, bringing less confidence and demand into the US dollar. On top of the last key inflation figures also showed significant decline, which has the markets price in a future lower interest rate environment, as obviously it shows that the aggressive rate hike cycle the Feds have done is doing its job of combating and starting to regulate inflation. For us to see the reversals on EURUSD, GBPUSD, and dollar bounce bullish from here, right? We're going to need these fundamental confirms. New fear, uncertainty, and doubt that's not directly impacting the US economy, that increases the US dollar's appeal to investors and smart money on its safe haven side. For example, You can see when Russia started to invade Ukraine, before the Feds even started their rate hike cycle, we already started to see buyers pooling demand into the dollar. Or even when the Credit Suisse collapse happened within the European banking sector, as it wasn't directly impacting the US economy, this gave dollar some strength in the short term. So if we get any new global fear, uncertainty, and doubt, such as escalations with military conflict that doesn't first initially involve the US military on a war front, maybe like China invading Taiwan, or if we don't get any other signs of fear, uncertainty, and doubt, like more banking sector fails in other regions of the world, such as Asia or Europe, then there's not much reasoning from the safe haven appeal side of dollar to be bullish. Other fundamental reasons would be appealing to the hawkish Fed sentiment and seeing strong US data, which we did have today. One of the main reasons dollar bounced so aggressively today and gold had that intraday downside move was rebounding Fed manufacturing business surveys report. But still, that one singular report is not enough for dollar to just confirm a bounce here, right? Higher inflation. Another reason is we need higher inflation figures. CPI figures, producer price index, PCE pricing figures. Higher inflation shows that the Fed still need to keep rates up for a longer period of time, still need to keep financial conditions tight. That's another fundamental real-world reason for demand in the US dollar. If we do not have these reasons, then dollar can just stall out around this area and still potentially break lower, giving us deeper bearish moves on the higher time frame. Because you can always rewatch this webinar as you wish and take notes. When I clear the chart here and zoom out, you're going to see overall in dollars higher time frame bullish bias since the 2008 GFC crisis, that seeing these aggressive waves in dollar price change is very normal. And guess what? Every single time when you go back test these periods in history, when you see dollar being extremely bearish, there's always been claims of new currencies or new types of technology to take over dollar. Like, oh, the yuan's going to take over. No, BRICS is going to take over. No, Russia's going to do something with gold and take over, right? There's always been those periods. Now, this is something very similar as we're getting this correction, but I like to take it level by level. Very similar to here, the first area of interest I was looking at is a retest of this key liquidity zone and very important historical price point. Very similar to like this, when we had this aggressive phase, but still more buyers pooling into the market. This is the first higher time frame area of interest. If we can't break here and have those fundamental catalysts to support dollar buyers coming back into the scene, then you're just going to retest here and start trending back to the highs. But understanding gold's historical price formation and how it moves, if we don't get those fundamental catalysts stated to support a dollar bullish bias, which again, just to put it in here, first key higher time frame area, roughly at 101.5 plus. Hawkish Fed pressure, higher inflation figures, stronger US economic data, new fear, uncertainty, and doubt on a global scale. Right? If we don't get these confirmations, as well as the order flow confirms of failing to trade lower, then you can easily assess that dollar having an even deeper downside wave on the higher time frame into the 95s would not be out of the ordinary. This doesn't mean that dollar's no longer going to be the world reserve currency. This doesn't mean that dollar value has dissipated. Of course not. It's just understanding from our perspective as manual retail traders, doing some back testing and review of the higher time frame, that dollar moves in these very large waves in price formation based on important fundamental catalysts. The reason dollar was so bearish here was the Fed's exponentially increasing money supply, pumping the markets, keeping interest rates at zero, and all the market demand was in risk assets, like in real estate or in equities in the stock market or commodities. So dollar flatlined here. But you can see, conveniently, as we came to retest that key liquidity zone, we had Russia start to invade Ukraine, more demand pool into the dollar. Then the Feds did their most aggressive rate hike cycle, and that was the reason we've been so bullish here. Right? Now, this correction we've seen so far is coming to retest this key price point of interest. We need to see a combination or these confirms alongside failing to break lower to see dollar domination come back into the scene and reversal from this price point. If we get these confirmations, that gives us clean cut confirms when we're going back to our dollar pairs like Euro USD that this webinar is focused on, that will see a reversal here. Otherwise, if we don't get these confirmations, dollar's going to be breaking below 101 and starting to have bearish legs to 95. That's going to correlate to Euro USD having a deeper aggressive pullback phase all the way into 1.15. More than likely the correlation, dollar as the world reserve currency goes to 95, Euro USD is going up to 1.15. Does that make sense to everybody on a macro perspective? I think the chat's back online now as well. There was something glitching with the permissions. For some reason it was saying the webinar was for kids, but this webinar is not for children. Right? So what I'm really trying to highlight at the start of this webinar is that both dollar and both Euro USD are at very, very important higher time frame price points. This is a very key higher time frame institutional price point. Clearly we can see based on history around 101.5. But just because we're having this initial reaction here doesn't mean we're guaranteed the double bottom and bounce and dollar domination coming back into the scene. We're gonna need hawkish Feds, good US data, new market FUD, higher inflation figures. Okay? Otherwise, dollar on the intraday perspective can easily still be messing around in this area and starting to dig lower. So keep that in mind. But right now, when we're looking at Euro USD, one thing you have to understand is we were just zoomed out being objective on the higher time frame. You want to bring the higher time frame principles and concepts but down to intraday application for a retail trader. Let's look at Euro USD here and understand something. When you're back testing Euro USD, whether you are bullish or bearish, you have to understand from a retail trading perspective that you could be having an accumulation of order flow and retesting some of these liquidity zones multiple times over a period of weeks and months, right? You can see here that same area got retested again before finally still continuing trend. You can see the same thing here and so forth, right? Why is this important? Well, from a day trading and scalping perspective, these price formations in blue are hundreds and hundreds of pips of daily bounces going up and down the ranges here. right? Sometimes even breaking lower, still snapping back above to that same liquidity zone. So we have to understand something. One marked in yellow now, for most traders from a manual retail trading perspective, and now you're getting a little bit of a psychology lesson and experience lesson, most traders, they don't burn their accounts and have problems when the market's clearly trending and you're having these bearish downside legs, right? When you're having these clean melts, confirmations, dollars bullish, extensions of trend, everybody's happy, everybody's making money, right? Where traders get burned, especially inexperienced manual retail traders, are these periods in blue for these extended periods of times marked in yellow for days and weeks. When the market is retesting a liquidity zone, ranging hundreds of pips between highs and lows, accumulating order flow before potentially extending trend. This is when traders have expectations and just hopes we're going to melt and continue the trend. This is when they're not being selective and adjusting their risk and execution accordingly. Listen to this very important piece of advice from my 6 years of trading. How you trade in this red box versus how you trade in this blue box should be different. You should be less aggressive, more selective, and more patient when price is in a similar type of anatomy as highlighted in this blue box. And you should be more aggressive, more confident, and scaling positions in when you're having these continuations of trend in the red box. And you can't say that it's not easily defined. Like, you can't easily assess bearish market structure holding weight for days and weeks, right? Just like you can easily define these consolidation zones here, right? So everybody's making money. But so this is just an example to show you on EURUSD. It can be applied to any trading asset class, but this is an extra lesson on top of this webinar now. But anyways, the point I'm trying to wrap around and come to is that we're in a similar situation here. We don't have full signs and confirms of reversal just yet. We're still respecting this bullish structure from these lows and parity point. Yes, we can't ignore these rejection signs here, but understanding how this pair behaves and understanding the overall intraday price movement, EURUSD can literally be doing something like this for the next period of days to weeks before finally getting the bearish leg down, dollar confirms, and reversal. Does that make sense to everybody? And when you're looking at the chart right now, this may not seem like much, but it ends up being EURUSD in a larger range or consolidation zone of 100 to 200 pips for a period of days and weeks. Does that make sense to everybody or no? Is everybody following along in the YouTube chat? You guys can send messages now, right? So right now, as a lot of the major fundamental catalysts have been priced in, right? The major jobs report, the last FOMC, all of these banking sector fallouts, we haven't really had any new fear, uncertainty, and doubt. It would not be out of the ordinary to see price formation like this, and that would be completely normal when you understand how this pair like GU behaves. Look at here, for example. These are just very brief examples, right? But look at this. This is a 100 to almost 200 pip range here, 150 pip range that Euro USD remained within, that most retail traders are going to be burning their account through for almost 3 weeks. Right? This is from like July 18th, for a month. It was a month. Right? Here you can see the same idea, where as you are having these price setups slow down in market volume and volatility, this is where a lot of retail traders end up getting burned. They waste their time and capital here for a period of 2 weeks. And then you finally get the shifts in structure and impulsive legs down. So right now, when we're coming to look at Euro USD here, I would not be surprised where when we're looking at this last key rejection point, and then you're also looking at that bullish market structure and some of these key areas here, right? Euro USD can be in this area for an extended period of days and weeks, even going into next FOMC, where we need a lot of hawkish pressure from the Feds before we start to get the reversals. You can see it on the daily time frame. Those periods of indecision highlighted a lot easier. But just showing you on the intradays because that's what we focus on. So now, right now, when we're looking at Euro USD, we're still respecting this bullish structure, and I'm looking at this price sensitivity area roughly around 1.085. If we still respect here and don't have dollar trading well above 102.5, we can easily be sweeping these highs again before really starting to get the reversal signs. We don't really have much going on in terms of economic data over the next day. Some of the more important economic data is later in the week. We don't really have any Euro data, and we just got some housing figures for the US tomorrow. So I'm expecting volume and volatility to be lower and slower, especially as we don't have any new reactive events. Keep that in mind too. Unless we get some new fear, uncertainty, and doubt over the coming sessions, more than likely markets are going to have lower volume and volatility and be ranging. So for me, the trade ideas I'd be looking for, understanding the intraday structure and current flow of Euro USD, is over, and understanding the higher time frames is overall we're still having buyers print these intraday higher highs and revisiting those same liquidity zones, right? We still have these very aggressive pullback phase, which is very, very common. We haven't broken overall bullish intraday structure yet. So I'm still expecting movement like this, where we can easily be sweeping these highs again before seeing the real reversals coming into play with fundamental catalysts to support it, which I think is going to be in the next weeks and into the next month. Otherwise, we can't really see any safe further sells unless we're breaking below bullish market structure, having dollar trade above 102.5, and having fundamental confirmations for Euro USD weakness and dollar strength, which we don't really have any data reports over the coming sessions. Reactive fundamental catalysts have been quiet. Dollar still rejecting the 102 area there. And I still want to play this structure and sequence of events. So bringing that information together with some of our key levels in intraday zones, my main bias is if dollar rejects 102, I would still be looking for these buys based on that higher time frame and intraday analysis up into potentially better sells at 1.04. Fail to break current lows of 1.091. Break above key level 1.093. No new FUD over the coming sessions. Otherwise, the only way I see us jumping back into sells and expecting reversal is our buy analysis here being invalidated, meaning we don't get this step of the daily just making a lower wick, failing to break any new lows, coming back above the higher time frame key level and scaling above these price points as well. And you need dollar trading above 102.5 and fundamental confirms for that. Which we don't have these confirms right now. So this would be our adaption area. This is my main expectations. Okay, everybody, I don't want to make these webinars too long. They always do end up being too long. No, BRICS is not the end of the US economy. Petro yuan, none of that shit. Transformer people. But yeah, just a little educational webinar, some higher time frame and fundamental review on Euro USD, on dollar, breaking down higher time frame market waves, understanding market timing, sentiment, various phases of market structure, whether you're in an impulsive phase or accumulation phase, how to adapt psychologically from a retail trading perspective, some quick psychology reminders, intraday analysis, and trade ideas. Make sure if you guys want more webinars like and subscribe. I'll probably do another gold update this week, a breakdown on the US stock market as well. And then I'll see everybody next time. Probably another webinar tomorrow evening or Wednesday evening.